is highlighting this particular candle's body, not the entire body of the candle, just the range that's being shaded here. Okay. Between those two reference points, that is considered, by my definition, I call it a fair value gap. Its classification is a buy side imbalance, sell side inefficiency, meaning that the delivery of price was on the upside. So think about a paint roller. Okay, and I've used this analogy before. If you wanted to paint a wall in your home, and you apply the paint to the roller, and then you apply that roller to the wall, okay, you're getting that delivery up. If you keep doing that from the bottom of the wall to the top, eventually paint will run out, and you'll see these little pockets, these little pits on the wall where paint didn't make its way to the wall. So you already know, what do you have to do? You got to roll back down over top of that to fill in those little pockets and gaps where paint was not distributed. Think about price the same way. Between these two reference points, that being this candle's high and this candle's low, that one candle right here in that shaded area that's purple, there's going to be small inefficiencies in that range that's shaded in purple. The easiest way to simplify it is, we don't need to know yet where those small little pockets are on the lower time frame, because this is a weekly candlestick. So inside that range I'm highlighting here with my cursor, somewhere along the line in that very week of data, there are gaps, inefficiencies. We don't need to know exactly where they are, but we can identify that range right here. As soon as that candle closes and we begin a new week, that gap that's shaded in purple, we know that there's a likelihood that the market will want to, at some future time, want to reprice to that. That is not balanced. All it means is that shaded area that's purple, it's buy side imbalance. So the market's shown an imbalance, meaning it wants to go up. It did go up. So what is it inefficient? It's inefficient in the sense that it hasn't had a sell side delivery. Sell side is when price is being offered downward, a down close candle. My down close candles are black. My up close candles or bullish candles are green. For that purple shaded area here, for that to be repriced to and offset the inefficiency of sell side, because it's buy side imbalance, it's imbalanced. It has to be balanced later on, and I'll tell you how it becomes balanced. But right now, what is it lacking? It's lacking sell side delivery. That means a candle must trade down in between the high and low of that purple range. And it's defined by the two candles I mentioned here. This candle's high. That candle's low. So in my mind as an analyst, I'm looking at this and thinking, okay, well, we've seen a lot of back and forth price action all through here. Okay, so inside that darker shaded pink area, inside that rectangle, notice how there was a lot of back and forth, up and down price delivery. You see how it's created like a small little trading range in there? Where is there a break in all of that back and forth movement? It's in that shaded purple area here. So up and down, back and forth, think about that paint analogy, all inside this pink area. If price was paint and the canvas that is the background of my chart is the wall, in that shaded area, price has done a very good job of moving back and forth inside that pink shaded area, but it didn't do a very good job of efficiently offering sell side delivery in that little area right there. So what the algorithm does, it seeks those areas there because it's easily defined by arrays, old highs and lows that are separated across a spectrum of 3 24-hour periods. Any separation between this time frame or any other time frame. I'm going to teach you the price delivery continuum today, so that way you can see from one time frame down to the smaller time frame, how did you pick that fair value gap and not this fair value gap? You're going to know all that today, okay? But you won't retain it unless you're paying attention and probably watch this video a few times. So we know that there is a strong tendency for the market to want to come back and reprice into these areas. For the dollar index, on the June 13th, 2023 price action lecture in market review, I was teaching on CPI, the minute marker 4 minutes. You'll hear me talk about a price level of 102.705. I want you to think about what I just covered here on the weekly chart, okay? I'm going to keep this just as it is here and drop down to a daily chart. So when I'm looking at price, I have all of this higher time frame weekly perspective in mind. So if I were asked, which time frame do I spend the most time on? It's the weekly chart. We'll call it a pale orange. That gap between this candle's low, that candle's low over here, and this candle's high. That's what's being shown here in that little pale orange shaded area that's noted as the weekly inversion fair value gap. That gap and this purple one here, they are called inefficiencies. Think about the paint analogy I gave you. When price is moving back and forth in a defined range, what's the defined range here? Where your eye looks at price, just like I have it shaded here in pink, price has moved rather efficiently inside that pink area, up and down. Okay, when price entered the low end of this pink shaded area, now we don't know that pink shaded area is the range yet. What I'm saying is when I'm looking at price, I'm looking at how price was delivered during a period of time in whatever time frame I'm looking at. So this is applicable to whatever time frame you're looking at, whether it be a weekly chart, a daily chart, 4-hour chart, 6-hour chart, 15-minute chart, a second chart. It doesn't matter. Okay, it does not matter. What matters is where are the inefficiencies and where are the stops. Above old highs is buy side or buy stops. Below old lows is sell stops or sell side liquidity. Those are the two things I'm looking for after my eye goes through the chart and I'm looking for the inefficiencies. So the first thing I'm looking for is inefficiencies. That's the first thing I'm looking for, because that's the array that the algorithm reaches for first. It pans for any inefficiency. If there's no inefficiency and we're in a premium and we're likely to go lower, then it's going to be looking for sell side. Reverse that. If we are in a range and we're in a discount and there is no inefficiency above price, but there's a short-term high, it's going to run for the buy side. That's what I'm doing on the weekly chart. So for the folks that are hammering themselves and beating themselves up, please teach bias. I just did. But what you're wrestling with is you don't have time looking at charts like I'm showing you here. You see this pink shaded area? How the market entered it, went up to this candle's high. The next week we opened up here. Then we traded higher up to this point here. Then the next candle or next week we open, we trade down and overlap all the way and into the previous high. So there is no fair value gap formation whatsoever in the candle I'm highlighting right now. Notice that? The candle to the left of it's high and the candle to the right of it's low. There is no separation like you see in that purple shaded range. That's a fair value gap. There is no fair value gap between the candle I'm highlighting here with my cursor using the candle to the left and the candle to the right. So what is actually happening there? The price has gone up and down, up and down. That's like that wall being painted very efficiently. Is there any inefficiency there? No. So at that time, when we start on this week, we open, we rally up, make the high, and then we close after making a low here. So there's been a lot of delivery up and down in between the range high of this week and the close of this candle here. Now, why am I picking that close? It's because I'm showing you how prices reacted in here and why I was telling you on the 13th in a live stream that can't be cherry picked. It was told to everybody watching it that I want to see dollar reach lower. Okay. And we haven't even got off the weekly chart yet. I'm teaching what I'm looking at. And this is why I'm trying to tell you, I spend the majority of my time on the weekly chart. I'm looking at how price delivered. Think about what I'm showing you here and how that relates to this area right over here. Think about that right in here. That same idea, we can apply it to over here. I promise you, I'm taking you somewhere. Even though if you think you don't know what you're understanding and confusion is probably peaking right now, just keep staying with it. I promise it'll make sense as I'm going. Same thing here. Price opens up, trades higher, back and forth delivery, all up to the high, back and forth, and then we leave it. So before this broke down, is there any inefficiency over here? Below this pink shade there, is there any inefficiency? Inefficiency would be like this candle here. How it has that separation between the candle's high to the left of it and the candle's low to the right of it. Does that occur or form anywhere underneath this pink shaded area in all this? Do you see that? Yes. Right here. I'm just going to use a short little trend line. I promise you folks, this is the stuff you're looking for. Even though you may not feel like it's important right now or it doesn't make any sense, I'm going to take you light years ahead. Most of everybody else out there today. So there's a gap there. So I would take like this rectangle here. I would highlight this, but I'm only showing it as a small little section with the rectangle not being here, but just simply using the trend line sections. So we have an inefficiency here. So when the market leaves this range, it's in a premium relative to the low and where it traded to. It's in this range consolidating, and then it leaves it. Where's it going to go? Well, there's several things. You can use the consequent encroachment of this wick, midpoint of that. Then you have the gap here that this traded down into, but left the majority of the gap still untouched, right? So when it drops here, price is going to want to trade into this area here. Does it do so? Yes. And again, that would be bias. That would be bias for that particular week for the dollar. What do you think that would mean for you Forex traders that want to trade pound dollar? What would you anticipate that week? This week I'm highlighting right here. How would you use that information? You would go into your charts and back test any long positions during the London Open between 2 o'clock and 5 o'clock in the morning, New York local time. You would look at your AM session kill zone, the New York kill zone, between 7 o'clock in the morning and 9 o'clock New York local time. You would look for the model 2022. You would look for optimal trade entries. You could look for silver bullets because silver bullets form in the kill zones between 7 o'clock and 9 o'clock. Ooh, what'd I say? Yep, we're teaching that again today too. It's not limited to just index futures and 10 o'clock to 11 or 2 o'clock to 3 o'clock in the afternoon for index futures. If you're a Forex trader, everything that I teach is applicable. Even though you see me predominantly teaching it in E-mini S&P and futures contracts, it's applicable to Forex. There's subtle little rules that you have to worry about, and time is the factor that's got to be considered. Because yes, there are silver bullets between 10 o'clock and 11 o'clock in Forex, yes, but they are really good ones between the 7 o'clock and 9 o'clock New York Open kill zone, and between 3 o'clock and 5 o'clock London Open kill zone. So they're there every day. Every single day, you have a reason for you to find a setup. Now, again, that is not an invitation for you to go in and try to trade every single day, okay? So I want you to think about how the market moves in these ranges. This is a balanced price range. Why is that a balanced price range? Because the market has moved up and down within it, and then it left the range. So if it's going to leave the range, What is the algorithm? Let's make an argument for the sake of folks that don't want to believe there's an algorithm that controls price and there's no amount of buying and selling pressure that's going to change that. Market's going to go where the market's going to go. It's predetermined. Your daily high and low is predetermined. Whether you like it or not, it is what it is, okay? How can we determine where that likely higher low is going to form, or where would it likely reach to? Starting on these higher time frame weekly charts. And if we know that we can see prices likely to want to expand lower, think about it, because we're on what chart, what time frame up here? Weekly. So my analysis, everything that I'm doing on the weekend, when the markets are not trading, I'm trying to determine what's the strongest directional bias that can be derived by looking at the weekly chart. What is it likely to be reaching for on a weekly candlestick chart? It's going to either be reaching up for buy stops, or it's going to be reaching up for a fair value gap above where the market is right now. If it's likely to go lower, then I believe it's going down to a fair value gap below current market price, or it's going to go down to reach for sell side liquidity below some old low. That is not complicated, folks. These things on your chart, they're not hiding from you. They've been in plain sight. You just never been told to look at it this way.